Morning, ladies and gents. Simon Brown here. Not presenting today. I am merely facilitating. We've got two presenters. We've got Hannes Filun and Marius Hugo, who will be each presenting on their respective AMCs. I'm not going to delve into the mechanics and details. We've touched on that on the other in the series that we've done. This is now our fourth one, and I think we're all up to speed. If you have got questions around it, you're welcome to drop me an email, find me in the socials, or go watch the first in the series. We're going to start off with Hannes Filun, and then at the end of it, we'll take any questions we've got for the honey badger. Then we'll let him go, and we'll go to the second. But with that, Hannes, all yours.
Thank you very much, Simon. So today I'm not going to show you guys any numbers. What I thought would be a good idea is to go through the process we went to put this particular strategy together, and I'm going to do that by referring to one of the biggest sporting events in history. But firstly, why is process so unbelievably important? Now, a gentleman with the name of Michael Movison wrote a book, The Success Equation, and I can highly recommend it to anyone. And in this book, he looks at a continuum between luck and skill. And on that continuum, he puts various sports, business, and investing, and then he gives some advice on how to have luck play less of a role versus skill. So if you have a look at this continuum, skill is right here to the right-hand side, right? And chess is a game of absolute skill. So what that means is if everyone plays a chess game against Garry Kasparov, the probability of you losing 100 out of 100 games is probably high. It's a highly skilled game. If you have a look at the other side of the continuum and you have a look at that roulette wheel, if I play a game of roulette against Garry Kasparov, there is zero skill involved. It all really depends on luck. Now, the interesting thing here is where Mr. Movison puts investing. And he says there is a lot of luck involved in investing. But if you want to move your investing continuum over to pure skill, the biggest thing you can concentrate on is process. And if you've got a good and reliable process backed by data, the probability of you achieving a favorable outcome increases a lot. So the sporting event I want to talk about is a Rumble in the Jungle. So that was a heavyweight boxing match that took place in 1974 between George Foreman and Muhammad Ali. Now, interesting enough, this boxing match was scheduled to take place in September, but it was postponed by a month. And the reason being, during a sparring and training, Mr. Foreman's sparring partner, they said, nicked him on the top of his right eye. He sustained 17 stitches, and it was a month-long period that it took for that stitches to heal. So there was a bit of skill involved because Muhammad Ali had a few extra months, or basically an extra month that he could train in. Also very interesting, you'll see there on the poster, 15 rounds for a heavyweight boxing match. That's a lot. It was recently, well, not recently, in the 1980s, it was reduced to 12 rounds, but if you train and you're fit for 15 rounds, well, that plays into the advantage of Mr. Ali. But how did this all come about? Now, everyone knows Mr. Foreman as this guy from the lean, mean grilling machine, but in 1974, he was the undisputed heavyweight champion of the world. Now, it was actually Ali that challenged Mr. Foreman. And the reason being is that Muhammad Ali's heavyweight boxing title was stripped away from him 7 years earlier. Now, why was that stripped away from him? He was being accused of dodging the draft, of getting drafted into the US Army. And because of that, they revoked his boxing license for 3.5 years. So he basically had to wait 3.5 years before he could start boxing again. And then at the end, he could challenge Foreman for the title. When you have a look at the Badger, how did this thing start? We went and we had a look at a lot of data, and we found that the primary reason why investors don't achieve their goals at the end of their period is because they struggle to stay invested. They sell investments at the wrong time. They promise themselves that they're going to get in when everything looks a little bit better. But if you sell out, you are not allowing compounding to do its work. And that is the primary reason we started with this process. Now, the process consists of 3 steps, being what your objective is, the strategy and your tactics. You need to have the tactics right and execute in the ring if you want to have a positive outcome. Now, why objective? Well, Yogi Berra said, if you don't know where you're going to end up somewhere else. And Mr. Ali had a very, very clear objective. He wanted to regain his title. He was a little bit upset for about 7 years, and his objective was to win. For the Badger, what is our objective? Very simple in one sentence. We want to solve for the highest probabilities for investors to stick with their investments, to stay invested, let compounding do its work, and while earning a return of at least inflation plus 3%. Because if you can use this strategy as the core of your investment strategy, and if you can stay invested, earn at least South African inflation plus 3%, have your earnings compound, you can build satellites around this strategy to either try and increase your return to CPI plus 5, 6, or whatever the case might be, or you can actually try and decrease the return if need be, if you are a more conservative investor. But we want you to stay invested as long as possible. Now, what was Muhammad Ali's strategy? Well, he was definitely the underdog. Big George Foreman, pre-fight, he was really in the prime of his boxing career. His pre-fight record was 40-0. He's never been knocked out. He was only 25 years of age, and he was the undisputed heavyweight champion, WBA, WBC of the world. Ali was 7 years his senior. He hasn't been boxing for a while. He's been knocked out twice in his career before, one time by Joe Frazier, interesting enough, and the other time by Ken Norton, but he was definitely not the favorite. To what extent? Ali was 4-1 underdog when this fight started. So he had to leverage his advantages. Now, some would say Ali was 7 years the senior of George Foreman, but as I'm sure everyone knows, Muhammad Ali, he said, listen, I've got 7 years more experience. Ali had a lot of speed, a lot of mental toughness, and he was extremely, extremely fit. Now, Michael J. White, he's a martial artist, an American actor. He analyzed the fight, and he said one of the biggest advantages that Muhammad Ali had that people overlooked was the size of his legs. Now, because often Muhammad Ali was the biggest fighter in the ring, he needed to have extremely big legs so that he can move faster than his opponents around the ring, and hence make them tired. So if you want to sum up the strategy of Mr. Ali in one sentence, his strategy was to tire the overeager George Foreman out to the point of absolute exhaustion. And the moment he was exhausted, he would strike Mr. Foreman with all he's got. If you want to sum up our strategy in one word, it would be to follow a rules-based, data-driven investment approach. This will allow us to take emotion out of the investment decision-making process as far as possible, and then hopefully we'll be able to reach our objectives. As simple as that. Now, what tactics did Ali use? Well, Ali danced around the ring with his extremely strong legs. He frustrated George Foreman by ducking his punches. When he was pushed against the rope, he fielded punches. And when he was pushed against the rope again, he fielded more and more and more punches. But after 5 rounds, Mr. Foreman showed signs of being tired. If you have a look at the Badger, there's 4 things that we concentrate on. The first, one of the biggest rules that we look at is it's not possible to forecast the markets or the economy. We all know that this is just not possible. So how do we mitigate that? Is we design a strategic asset allocation for our portfolios and we stick with it. Does it change over time? Absolutely, it does change because scenarios change, right? Interest rates, for example, that plays a massive role. It does change. But once we set a strategic asset allocation, we stick with it. It is impossible to time the market. We all know that, but we struggle to sometimes stick with it. But we try to mitigate it by rebalancing. So the moment we set our strategic asset allocation, we will religiously rebalance to that on a quarterly basis. We let data lead the way. Now, what do I mean with that? Now, I want to use an example. Morningstar brought out the South African Active Passive Barometer last week. They looked at one of the categories was South African active equity managers trying to beat their offshore benchmark. Now, the amount of South African managers that have been successful by beating their benchmark, active equity, offshore this is, over a 5-year period, 9.9%. Over a 10-year period, that falls to 3.9%. So the probability of a South African manager being able to create alpha by managing equity actively offshore is very close to zero. The juice is just not worth the squeeze, so there we will go the index tracking route. If you have a look at South African fixed income managers, the story is a little bit different. Over a 5-year period, 54.9% of managers outperform their benchmark, and on a 10-year basis, 59.5%. So here it's actually worth going to a manager that specializes in the area and that's got the ability to outperform the benchmark. So here we will go with actually active ETFs within the actively managed certificates. And then lastly, Daniel Kahneman and Amos Tversky brought us prospect theory and loss aversion. And within that theory, they basically said a loss hurts twice as much as the equal amount of gain. So it will always be in the back of our mind that if there is an ability to reduce volatility and reduce drawdown, that will get precedent in our strategy. So what was the result? Well, we said Mr. Foreman showed visible signs of being tired in round 5, in round 6, and round 7. Mr. Ali became a lot more aggressive at the beginning of round 8. A lightning quick combination that it finished with a straight right, knocked Mr. Foreman to the floor. And now the infamous picture that we all know what the result was at the end of round 8. What will be the end result for the Badger? I humbly want to say that we don't know. No one knows what the future will hold. But we've got a very strong process that we will stick to, and we will stick to our investment rules unless other data comes around, right? And it contradicts our rules. But we believe if you stick with those underlying rules, the probability of you getting to your objective is that much higher. And I just want to use the final slide to pay tribute to Mr. Foreman. He unfortunately passed away on the 21st of March this year. He died at age 76. But have a look at, interestingly, what he said. He said that he put 25% of all his earnings when he started boxing into a trust, and he invested. He actually said he will do that because it's very important to have something to fall back on. And Mr. Foreman had many and many years of compounding playing a role. So if you take his boxing earnings into account, and him being the face of the lean mean grilling machine, when Mr. Foreman passed away, he had a estate of more than $300 million. And Simon, that's me.
Gent, I love that. I was too young to remember the fight, but my father was a huge fan, and he had listened to it, and I have heard about that one more often than I can. Hannes, I'm not sure if you've disappeared. It was just your camera that went for a minute.
Yeah.
A couple of questions coming through. The one you've kind of answered in the latest slide, but it came in from Tebogo asking, are you refining that rules-based process? In other words, do you go back? You started with a bunch of rules. Do you he says, do you check back on them? Do you potentially refine them, or are they written in stone and that's it for forever and a day?
No. So in short, the answer is just no. I don't think it can be written in stone. We describe it as strong convictions loosely held. Okay. And what we mean with that is we've got very strong convictions. We've got very strong rules. But if there is data that comes along that contradicts the rules that we've got, let's use an example. If it comes along that says Morningstar used completely the wrong data, and the amount of managers that can actually outperform the offshore index is 90%. I'm just using a rough number.
Yeah.
Will we look at that data? Absolutely. I think it would be foolish not to look at that data. Yeah. So strong convictions, but loosely held.
I like that. And then Tebogo, and he says this is a statement or a comment rather than a question. He says that the benefit of him holding is that we don't get shaken out. We're not. You started by saying the mistake we make is we sell and we promise to get back in. And he says he finds it much easier with a fund because there's just generally lower volatility because there's obviously a collection in it. So it makes life significantly easier for him. A question coming through. And it's around the asset allocation. You talked around strategic asset allocation. And the question is, surely that is in many senses at the crux of it, which is what is that asset allocation? And kind of getting that right for your target of CPI plus 3 is the sort of the really hard part.
Yes, absolutely. Probably 90% of that is getting your asset allocation right. And look, just in a nutshell, the way we do it is when you've got a real return target, it is our belief that you need to start off with fixed income securities, with bonds, right? And what is the reason for that? If you look at a 10-year government bond, it's a South Africa 10-year government bond, you buy it the date that it is issued at par, and it yields 10%. Bar the government going bankrupt, which can happen, at the end of that 10-year period, you'll get a 10% return.
Yeah.
So if you then look at that, that's a very simplistic way of looking at bonds and what they might return. But if you go through the process, you will probably give or take, get an expected return, not a forecasted return, but just a return you can roughly expect what you can get from bonds. And then from there on, if you need to take additional risk premium and you need to invest in equities, you'll get to that in order to get to that CPI plus 3 target. Will we ever have zero equities in the portfolio? The answer is probably no, and just the reason being, we need to humbly say that we don't know what's going to happen. If we were 100% sure that bonds are going to get there, everything will be invested in bonds, but we just don't know what's going to happen, and we need to have diversification right at the crux of our strategy.
Yeah, I take that. Another question coming in, this is around the inflation target. Does the change in the inflation target in any way change your CPI plus 3? And my imagination would be no. I mean, that's an interest rate decision. It's an NPC tool, but it's not going to change your strategy necessarily. Not going to change your target, rather.
100% correct, and that's why the reason why we have got CPI plus 3. That if anyone makes any changes to the CPI, that will immediately fall into the objective. But no, we won't explicitly make any additional changes now.
Yeah, cool. Folks, I'm not seeing any more questions coming through for Hannes. Hannes, really appreciate the time this morning. Ladies and gents, we're going to, Hannes, appreciate the time. The video will be, someone's asking about the video. That's going to be up, let's say, later this afternoon. At just one lap. Let's say by the end of business today, it will be up at just one lap. Hannes, thanks a lot, man. That was excellent.
Thank you.
Marius, give me half a moment to get us back to all the right places. Morris, we're good to go. It's all in your hands.
Okay, thanks a lot, Simon. Thanks for the opportunity to present. I'm going to start off by just giving some background on our what we call the MH Capital Growth AMC. It is capped at 500 million rand. Our benchmark is a bit higher. We look at CPI plus 8. Well, and the reason for that is you've touched on it, or Hannes touched on it. You can get a risk-free return of almost inflation plus 7 or inflation plus 6. So we try to obtain a bit higher return for our investors. Our management fee is 1%. Total expected total expense ratio is 1.25%. Myself and Sebastian van Wyk are the asset managers, and I think the most important characteristic of our AMC that stands out is that it's a very focused AMC. We only invest in 6 to 12 shares. So we're not, and that's in our mandate, not more than 12, not less than 6. And we also invest in small and large caps. We not, and that's one reason why we decided we don't want to go beyond 500 million rand, because then you start to you're not able to invest in the smaller cap companies. Because of this, we probably have a bit of a higher risk than the normal sort of investment out there. But we do, when we discuss our investment philosophy, you will see that we do mitigate our risk by investing. Well, one of our main primary rules is that we do not invest in companies with a geared with a high or a poor balance sheet. On the smaller companies, we only invest in companies with basically cash on the balance sheet, and so we are very sensitive for the balance sheet and how much debt a company has on its balance sheet. Our code is AMC 018, and we listed only about 3 months ago. On the 7th of March is when we listed. Well, Simon, I think if we look at AMC, and when I was involved in managing share portfolios for individual clients for many years, or many decades, and I really like the AMC. I think the AMC is a fresh and innovation that is long overdue in this market. If you look at the share portfolios, I mean, they've been managed the same way now for many decades, and things that did happen over time is that the minimums became a bit of an issue for some investors because it just didn't become profitable for them to manage all these portfolios anymore if they're not large enough. So the minimums are become a problem, and if you look at the AMC, that is accessible to all. It's basically anybody in our we don't really have a minimum. It's at the moment you can buy one share for 1,150. So it's very much accessible to all. But the most important benefit of AMC is that when this portfolio manager sells any share in his portfolio at a profit, there's no capital gains payable immediately. The capital gains is only payable once the investor sells the unit on the JSE. In the case of a share portfolio, obviously, if I was selling a share at a huge profit, then the client needs to pay that capital gains either in August or in February, and that often impacts on the decision making of the portfolio manager. And so, listen, can I really sell the share? What will the client think? And at the end of the day, it really is detrimental for performance. It's not good to think what will the tax implications will be. The other benefit, the large cap. I think most share portfolios are large cap focused. We also look at smaller opportunities. And remember, if somebody manages a share portfolio, they often have a few hundred share portfolios that they manage for individual clients. In this case, we have one single portfolio, and anybody can participate in that. So I'm very excited about this. I think it's long overdue that there's some change in what is offered to clients. Okay. Well, if you look at our investment philosophy, there are basically 3 people that influence our thinking. The first one is Warren Buffett, and obviously Warren Buffett is, everybody knows him, and we have a lot of Buffett followers as well. I think there are two things that everybody overlook if they look at what Buffett does well, and one of them is Warren Buffett always have cash on the cash in his fund. At the moment, I think it's something like 30% or close to 30% of his market cap is in cash. Now that's a very powerful tool. If you have cash when everybody else is taking strain and it's basically bleeding on the investments, then you can really buy some stocks and make investments at very good prices. So that's one thing that's overlooked. The other thing that I've learned from Warren Buffett is they say, when do you sell a share? Obviously, you sell a share when the share is too expensive. It's a bit subjective. Sometimes your expenses and my expenses is not. We have different views sometimes about that, and different discount rates and stuff like that. But he has one specific thing that he looks at. He says he sells a share when the company is losing or has a diminishing competitive advantage, which is quite an interesting way of looking at the company. And we had an example recently in our fund that we liked Untitled, but I think Untitled is a good example where the company is experiencing a diminishing competitive advantage with all the competition that came in on the just across the border and even in the local market. So that's what we've learned from Warren Buffett. We've also learned the other guy that we follow quite closely and that we are great believers in is a person with the name of Terry Smith. Terry Smith manages the Smith Fund, and he has a huge and a very, well, his long-term performance is excellent, and he's done very well with that fund. And his view is simple. He says, listen, I'm buying a good companies I just want to make sure I give you the right information. I buy a good company, I don't overpay, and then I do nothing. Now, if you buy a good company, what is a good company? Terry Smith says a good company is a company that invests, or his return on invested capital exceeds his weighted average cost of capital. And then you can go even further and say, listen, and there are opportunities within his business to invest that capital. So there's some growth opportunities. He can invest in his own company, and he can obtain a return on invested capital that exceeds the weighted average cost of capital. And then suddenly you have a compounding effect where people invest. Your earnings compounds, your NAV compounds, and obviously that will reflect in the price. So once you have a company like that, you just invest and you sit back and you do nothing. Third person that we follow closely is a guy called Rob Vinyl. He runs the RV Capital Fund. Quite interesting. If you want to invest with him, you have to apply. You first have to send him an email, give him some info, and then he will decide whether you are welcome to invest in his fund. And the reason for that is basically he doesn't want impatient investors. He doesn't want investors to be in and out of the fund, and he wants the investors to invest like an owner. And that's exactly what we also like. We like our investors to be patient, and not go in and out, and that causes all sorts of practical issues if you go in and out for the portfolio manager. And obviously, a very important point that he makes: you must remain level-headed. And I know everybody knows that, and everybody say they will remain level-headed until something significant happens, and then there are very few people who are level-headed. And if you can combine level-headedness with a lot of cash in your portfolio, then you are in a great position, and you will probably make strong returns going forward. Okay, so what we do, we look at undervalued opportunities. We like what we call a conviction-led investment approach. The focus portfolio, I don't think we have 70, 80 quality companies listed in South Africa. I think it's closer to 15, 20 maybe. So we really want to invest in quality companies with a strong balance sheet. And just interesting, just a point I want to make, we don't really view a risk as in terms of volatility, not in terms of illiquidity either. I mean, we are also, this is part of a bigger fund. We also have private equity components that we run, and this is so we have what we call a hybrid fund, where a certain amount of the money goes into our AMC, and the rest we put in unlisted investments. So we are used to illiquidity, and we actually like illiquidity because sometimes it brings the prices of the investments down to very, very good levels. So our key investment criteria, we must have high return invested capital. There must be a clear path for scaling. We especially like platform businesses where you can scale. The low debt levels is non-negotiable, and then we obviously need to trustworthy management. So that is the way we look at our companies, and we are heavily influenced by the three gentlemen I just mentioned earlier. So currently, if you look at our portfolio, you'll see what I've just discussed here. You will see it's reflected in our portfolio. Our current cash levels are at 25%, which is probably a little bit too high, but we are currently 25% in cash. Our biggest investments are Stadio. We've been invested for a year or two in Stadio. It did very well for us. We still like Stadio. It's probably a little bit expensive at current levels, but over the longer term, we think we're going to make a decent amount of money from Stadio. AdCorp is the other end. Actually, our largest listed investment is AdCorp, which saw a nice price jump recently after the results. AdCorp is also a portfolio investment for the capital value capital partners in Joburg, and it's not a bad idea to see where they invest in, because they have a very good track record of turning companies around, from Ultron, AdCorp, and they're also in PPC now, invest into PPC. So it's a nice crowd to follow if you're into the smaller caps. Berkshire is our only offshore investment at the moment, and as Hannes mentioned, we only invest in Berkshire and ETFs offshore. We don't try to find the winners offshore. The winners will hopefully find them on the local market. The large caps we invest are the old favorites, the Naspers, Richmond, Capitec. We like all of them. We also started to invest in Anglo-American recently, just before the unbundling. We probably built up a bigger stake there going forward. Purple is an interesting one that we recently started to invest in. And the reason for that is we think, given the technological changes and AI and everything that happened, or is happening at the moment, that the financial sector is due for a bit of a shake-up, and I think Purple is very well placed for that. Also a type of a platform business, in the sense they have currently 1 or 2 million 1 million active clients and 2 million clients. So it's very much like a Capitec, where you have a market, or where you can sell your products to, and so we like Purple. We think it's something maybe that we will increase our stake going forward as well. Raubeck was a bit of I wouldn't say a short-term opportunity. It's a good company. Was a little bit cheap a few weeks or so ago. Boxer is the other one that we have in the portfolio. So that's what our portfolio looks like. Focused offshore exposure through Berkshire and ETFs going forward, and yeah, we invest in any company, large or small, that can give us growth going forward and give us a decent return. So since we invested, since we listed on the 7th of March, the portfolio performed quite well. We up about 15%. The general market is up about 8% over the same period. But we only got started, and we are cognizant of the fact that investments are difficult, and but we are very excited about our AMC, and I think we perform relatively well going forward.
I really appreciate that. Folks, if you've got questions, drop some questions in. Let me just pull up that one there. Yes, that's what I'm looking for. Maurice, we appreciate that. Some questions coming. The one is around trustworthy management, and some of it, looking at the stocks you're holding, Richmond, Jan Rupert, he's well known in public domain. Berkshire Hathaway, enough said there. But the question is, how are you? I mean, are you doing meet and greets? I mean, for example, do you go have a cup of tea with Charles Savage at Purple? How do you gauge that trustworthiness? Because I take your point; it's hugely important, but also sometimes perhaps difficult.
Yeah, no, we actually did meet Charles, and I think Carl is his second in command, so we did meet him, and yeah, we feel comfortable that his vision of the company is the right vision, and we believe that he's got enough enthusiasm to and support to build it into something significant. You see, a good company or a good management doesn't change overnight. I mean, it's a culture, and it is really something that it's in their DNA. I mean, Capitec is a good example. Gerry Fourie is leaving, but I think there's a lot of people that is able to fill these boots. Richmond is a good example. Even with Warren Buffett now leaving at Berkshire, it's just that just a way of thinking is so entrenched in their way of doing business that it doesn't change overnight. It will take, and the reverse is also true. If a company has a bad culture or a bad management, that also doesn't change overnight. So yeah.
Yeah, and you've answered the second question that came through. What about executive changes at Capitec and Berkshire? But I take your point. It's the culture. It's in that corporate DNA in many senses. So the new ones coming through are known entities and going to bring with that culture. The question around debt. You say not too much debt, and the question from Tebogo asking: is it? I mean, do you have absolute levels? Is it like a debt to equity of a certain percentage? Or is it a sort of a judgment call that you make looking at the balance sheet, cash flow, and the like?
It's a judgment call, and I think the smaller the company, the more strict we are on the debt levels. My opinion is that debt strangles companies. It is really a company with a lot of debt can't make acquisitions when the prices are low, because then they're also under stress. So I think it strangles, but just to give you some indication that sometimes there are exceptions, is that Kaap Agri has a lot of debt, but the reason they have a relative large amount of debt is because they did that big transaction with the fuel company. So and they are very much, and that transaction translated into a lot of cash flow, which they can use to service the debt. So we don't have a specific debt equity, but I would say 20%. I would say starts to get, which is it's on a level that I'm not so comfortable with.
Yeah, got you on that. Question coming through: is the fund paying out dividends, or are you just keeping dividends and reinvesting back into the fund?
Just reinvest it. Yeah. If you want dividends, it's less like a unit trust, so it just accumulates in the fund.
Yeah.
So if he wants, he must, or the investor can sell a few shares if he wants some income from it, but we're not paying it out.
Yeah, and that's always been Warren Buffett's philosophy. He keeps the dividends, but Berkshire doesn't pay a dividend. He says, if you want some cash, go and sell the share. And truthfully, you get a better tax treatment. Maximum capital gains is 18%, whereas dividend withholding is 20%. I'm not seeing any more questions coming through. Maurice, Hugo, really appreciate that. Was excellent. Thank you very much for your time. Ladies and gents, thank you all for coming through as well. Thanks all.
Yes, thank you. Bye-bye.